Hello guys, today I'm going to be making the video speaking about options and how to trade options and what to look for in options and kind of the definition of what I look for when buying an option or a call or a put. So for example here, we're going to look at the options that I have currently right now. So what you want to do on Robinhood specifically if you want to buy an option, let's just click Apple for example, and we're going to click trade options. And on top here, we're going to be provided with expirations date. So the closer it is to expiration date, the more riskier it's going to be. So as you move out, you have all these expiration dates that are set here. All these long calls and covered calls and long puts are a different strategy, which is more complicated to understand. But for now, we're going to speak how to buy an option, how to trade an option, and what to look for. So here, for example, I believe we currently own a 182 call. So taking this one for example, this is an option and I'm holding one contract at the moment. So you would click trade and then view all options. So here we're showed and provided with all the strike prices. So the stock share price currently is at 182. So if you are closer, for example, this 182 call is closer to the stock price, so it doesn't take much to move to start making money. So 2.24 is how much the contract is worth. So you times that by 100 and this contract will be worth $224. So with this chart now, we're provided with all the statistics of this call. So first off, IV is implied volatility. This is basically market's expected move in the stock price in the future. And you want to look for an IV that's kind of low, depending if you're, doing a long call or a short-term one. So usually what I like to go for IVs is depending on what I'm doing. But for this specific one that I have, the IV is pretty low at 17. It's not too high. Again, this can change with earnings and stuff like that, and it can be up to like 60 or 50. That's kind of the expected move of the market. So moving forward, we have here, it just provides us with the low of the day of the contract and what it was worth, and the high, and then what it closed at. So it closed at the percentage kind of higher than the low one. But then we have volume. So volume is how many people are buying and selling this particular contract. So I typically like to look for contracts that have kind of high volume, so I know that they're able to get filled faster, because you don't want to be in a stock that takes long to get filled and then you're kind of stuck with selling your contract at a lower price of your profit, if that makes sense. I can make a more explained video later on, but this is kind of just the basis of how to buy an option and what to look for. So now moving forward with open interest. Open interest is how many investors are interested in this specific particular contract and have open positions. So this is not positions that have been closed. So those are subtracted or excluded. Now moving on to the important factors here, the Greeks. So delta is the value of an option and how much it will be worth when it moves up or down every dollar. So that's kind of confusing to understand, but every dollar it moves up, you would make $50 or 54, I believe. That's kind of how it is. Correct me if I'm wrong. But with gamma represents the rate of change between an option's delta and the underlying asset or stock price, either or how you want to view it. So typically you don't really look too much at these. It's kind of the delta and theta and IV crush that I like to look at. So theta is the rate at which the option decreases over time. So this, if you just hold the contract, over time it loses value. Most contracts expire worthless. So as time goes, your options is going to lose contracts. So you want to either be sure the stock's going to make a move and you're going to expect a move soon. You don't want to do this and just let it decay over time and move sideways. That's going to kill the contracts. So with that being said, when you want to buy one, you're going to go ahead and click buy, and you're going to be shown with this screen here now. So limit price and the bid is 222 and the ask is 224. So what I like to do is I like to stay in between. So if the bid is 222 and the ask is 224, and the person selling this is asking for 224, so $224. The bid is what I want to pay for it. I want to pay for it, $222, but I might not get filled. So to remove this like risk, I usually just go for the ask or for in between. So I would write one contract and I would put it at 2.23, and it should say medium fill, meaning that it's kind of like in between if it's going to fill or not fast. So I know if I put the ask, then it's going to fill automatically. So now moving forward, we're showing with this screen, showing our profits here. So if and on expiration date, Apple is at 183, I will lose $143. Now, if Apple stays above 185 on this day that my expiration call expires on, I would make $107. But this is not the way I do it. I usually try to trade the premiums. So as the stock price goes up, the premiums goes up as well. So the premiums are the one I'm buying it for. So I'm buying it for 224. If I bet that Apple is going to go up within a day and it goes up 1% and the premiums go up to $350, then I just made about $100, and that's when I usually sell them. So I don't like to do swing trades and swing calls, longer dates because of data, and I just try to make my calculations short term. That's the way I trade, and that's the way I like to do things. If you guys want a more in-depth video about options, I can do that as well. But for now, that's just what I'm gonna be showing you guys. And I did take away a couple $100 off my Robinhood here, but on my stocks, I was only up 37, so I ended up taking a couple calls here for Tesla and McDonald's, but I'm holding a couple more for tomorrow, so I'll make a more in-depth update on our portfolio sooner or later. Thank you.